Every investor dreams of buying low and selling high, but when the market dips, fear takes over. Headlines scream recession, analysts predict doom, and retail investors panic sell at the worst possible moment. When strong stocks dip, it's not time to run, it's time to buy. Right now, the market is offering some of the best dip buying opportunities we've seen in years. Whether it's AI stocks cooling off after a massive rally, tech giants pulling back from all-time highs, or small-cap growth stocks trading at a discount, the setup is there. The key is knowing what to look for and having the confidence to act when others are hesitating. Welcome to Crown Trading, where we specialize in teaching investors how to trade momentum and growth stocks. I've been a trader for over 10 years and have traded countless strategies until I found one that made the most sense to me. Momentum trading. Let's break down 5 reasons why this is the perfect time to dip buy stocks and how traders can take advantage. 1. Strong stocks are pulling back, not breaking down. A market dip doesn't mean the bull run is over. In fact, healthy pullbacks are a natural part of any long-term uptrend. The best stocks don't go up in a straight line. They surge higher, pull back, consolidate, and then make another move up. Recognizing this pattern is key to successful dip buying. Look at Nvidia. In 2023, the stock ran from $15 to $50 in less than a year. But along the way, it had multiple pullbacks of 10 to 20%. Each time, traders who bought the dip instead of panicking saw massive returns as the stock continued its climb. The same thing happened with Tesla during its historic bull runs and with Amazon over the last 2 decades. Right now, we're seeing similar setups across multiple sectors. AI stocks like Supermicrocomputer and Palantir are pulling back after big rallies. Even mega-cap tech names like Microsoft and Alphabet have cooled off from their highs, offering better entry points for traders who missed the first wave. The key here is understanding that a dip in a strong stock is not the same as a market crash. If a stock has strong earnings, high demand, and a solid long-term trend, a dip is an opportunity, not a warning sign. Traders need to differentiate between stocks that are temporarily weak due to external market conditions and stocks that are genuinely broken due to internal flaws. 2. Market fear creates the best buying windows. The best dip buying opportunities don't come when everyone is bullish. They come when fear is high, investors are panicking, and stocks are selling off irrationally. Warren Buffett said it best: be fearful when others are greedy, and greedy when others are fearful. Think about March 2020. When COVID hit, the S&P 500 dropped over 30% in a matter of weeks. Investors panicked, but those who dip bought quality stocks made some of the fastest gains in history. Companies like Apple, Tesla, and Shopify doubled or even tripled in the following months. Fast forward to 2022, when inflation fears crushed growth stocks. Many high-quality companies were trading at massive discounts, but investors were too scared to act. Those who dip bought names like Meta when it was under $100 saw it climb back to over $350 in just over a year. Right now, fears of a recession, interest rate concerns, and inflation worries have created hesitation. But history has shown that buying during moments of fear leads to the biggest long-term gains. AI stocks like C3 and Palantir saw sharp sell-offs after hitting massive highs. During these dips, many investors worried that the bubble was bursting, but smart dip buyers took advantage of this temporary weakness, positioning themselves for a massive rebound as the AI trend continues to unfold. The same applies to tech companies like Nvidia and Meta platforms, where short-term pullbacks have created incredible opportunities to buy at a discount. 3. The bull market is still intact. A dip isn't the same as a reversal. Many traders make the mistake of thinking every pullback signals the end of the bull run, but the overall market trend is what matters most. Right now, we're still in a strong uptrend, and that means dips are buying opportunities, not exit signals. The S&P 500 and NASDAQ are still holding key technical levels. Earnings reports from major tech companies remain strong, and there's no sign of a major economic collapse. The Federal Reserve is expected to start cutting interest rates later in the year, which could fuel another leg higher for stocks. In the past, every major bull market has had periods of volatility. The dot-com boom had multiple 10 to 15% pullbacks before peaking. The 2010s bull market saw corrections along the way, but continued higher for a decade. Right now, AI, semiconductors, and fintech remain the hottest areas of the market. Stocks like AMD, ASML, and Coinbase are seeing temporary weakness, but the long-term trends remain intact. If you've enjoyed this video so far, hit the thumbs up button down below. That way, you can help spread our content to as many people as possible. Also, if you are interested in getting our top stock picks that work in any market environment emailed to you every week, hit the link below in the description to get our next picks now. Fourth, a shift to value offers a smarter entry point. While growth stocks dominated the market for much of the last decade, there's a growing shift toward value and defensive plays due to economic uncertainties. Value stocks, with solid earnings, stable dividends, and lower valuations, are becoming more attractive as interest rates rise and investors look for stability. The pullbacks in high-growth stocks present a chance to buy into value companies at more reasonable prices. Big names like Johnson & Johnson, Procter & Gamble, and Coca-Cola have proven to be resilient during market downturns, making them attractive buys during dips. Moreover, many stocks that saw explosive growth during the pandemic, such as Peloton and Zoom, have pulled back significantly. While they might have lost some of their pandemic-era momentum, they still have strong business models. 5. The power of dollar-cost averaging. DCA allows you to invest a fixed amount of money at regular intervals, regardless of the stock's price. When the market dips, your money buys more shares at lower prices, which lowers your average cost per share over time. For example, during the pullback in 2022, many investors used DCA to accumulate shares of companies like Microsoft and Amazon. Instead of waiting for the perfect entry point, they bought consistently and ended up with a lower cost basis as the stocks rebounded in 2023. Traders can use it to build positions over time in sectors they believe in, such as AI, clean energy, or cloud computing. The consistent approach prevents emotional decision-making, helps mitigate risk, and positions you for future gains as the market recovers. Buying the dip isn't easy. It requires ignoring fear, trusting the trend, and having the patience to wait for the market to rebound. The market is cooling off, but the overall bull trend remains strong. AI stocks, big tech, and growth names are all offering better entry points after recent dips. Those who hesitate might find themselves chasing the next rally instead of profiting from it. Watch the next video on the screen to learn more about the momentum strategies we are using in the stock market.